Hi, everyone. My name is May, and Guy and I co-run the tax discussion group this year. I'm a PhD student in sociology, and Guy is a PhD student or graduate student in law. And then we also here have Dominic DeCogan, who helped found the group with me back in 2015. So today we have a pretty special treat. We have Professor Alison Christians from McGill University in Quebec, Canada. Alison's H. Heward Stegman Chair in the tax law at McGill University, and she's also a associate research dean at the moment. And so Alison has been writing about Pillar 1, which is part of Action 1 in the BEPS on tackling the digital economy. And now she's going to give us a talk and kind of give us an update on exactly what's happening, contemporarily at the OECD with this project. So Alison, thank you.
Well, thanks very much, May. What I thought I would do is give you the kind of big picture here, and then a little bit of a dive, not too deep, and then contemporary, what's been the rumblings of the last couple of days. All right, so where are we? Why are we here and where are we going? Well, where are we? As you said, May, the discussion on BEPS started around 2012. We now hear that we have implementation plans in place for 14 out of 15 action items. The space is not the final frontier. Digital tax is the final frontier. At least it's the final frontier in this round of tax norm negotiation, right? We know for sure there's going to be another one. And we're still on track, in theory, to present a consensus position by the end of the year. So who's mad about digital taxes? Well, this is based on a timeline that I put together, posted on Twitter, and within a few hours had people telling me a few that were missing. So what you see there is there's a number of countries that have a digital service tax, some sort of digital service tax in force. There's a bunch that are proposed, and there's a bunch that are thinking on it, but haven't acted yet. And this is important because, as you know, the US is not too happy about these things. We'll talk about that a little bit later on. So this is what I've done over the last couple of months or so. I start with the Secretariat's proposal. I read through it and try to come up with a formula, like what's the formula for how they're going to figure out how the digital services tax is supposed to work in Pillar 1? Like, what are they going to actually technically do? And if you can sort of piece it together from their proposal, they use all of these letters, X, Y, and Z, and they W, and they sort of draw it out in these examples. So I started there. And then, of course, we got the impact assessment in February, the Secretariat's impact assessment. So I started looking at the impact assessment and trying to plug in the percentages that the OECD was proposing when they were thinking about, well, what was going to be the effect of the Pillar 1 all over the world, so that the countries could start to decide, well, our digital unilateral digital taxes that we're thinking about or have actually proposed, can we let those go and go the OECD way? So we're going to have to do an impact assessment to try to figure it out. So I read that impact assessment, but it's a PowerPoint. Some of you may have been at OECD presentations where they've explained that PowerPoint, and it's somewhat illuminating and also somewhat frustratingly not illuminating. So I'll talk about that as we go through. And then the third piece of my analysis is this report by KPMG for Microsoft. You can see from the cover of that report, it's called Transfer Pricing Analysis, and it purports to be a research study or analysis, but really it looks like a transfer pricing report, like how you explain your transfer pricing position. This KPMG analysis is not public, but it was discussed in Tax Notes International, and I read about it, and then I got my hands on it and looked through that and used some of the insights from that. Put those three together, and I think that we can draw a preliminary picture of what Pillar 1 is going to look like, how it's actually technically going to work. Now, before I say that, I want to actually just note, in case anyone's forgotten, that this language is from the OECD Secretariat's proposal. It says the proposal is the Secretariat's view. It's not, this is very unusual in international tax. So normally the OECD is an aggregator of the policy preferences of its membership. And so whenever the OECD issues a report or floats an idea of here's the way we're going to go forward, it's an aggregated view of the preferences of the OECD member countries. And this is really unusual. And when I first saw the language, I scrambled. I said, okay, have we seen this language before? And it was starting to crop up in the Action 1 stuff. So it tells a little picture that some of you on the call will be more able than myself to, narrate, which is that there's something about this process that is maddening to the OECD. They cannot aggregate the preferences, much in the same way that the League of Nations could not aggregate the preferences a century ago. And so what happened when the League of Nations couldn't aggregate the preferences? They pushed out several model agreements, and then there were a number of meetings over years, and then eventually some pieces stayed and endured, and other pieces fell away, and we came up with the initial treaties, bilateral treaties. And remember, the League of Nations always thought those bilateral treaties would eventually create harmonization, de facto harmonization, and we would have a multilateral agreement someday. Now, the OECD is not of a mind to put forward 2 or 3 competing proposals the way that the League of Nations did. They have one proposal, the Secretariats proposal. So some of you have heard me complain about that. I complain about that because the piece of the puzzle that I see missing is that there were 3 proposals that went into the Secretariat's thinking on digital taxes. One was clearly associated with the US view, or the preferred US view. One was clearly the UK preferred view. And one seemed to come from India, but seemed to represent a group of developing countries. And in the OECD Secretariat's proposal, no surprise, the US and the UK views are there, and the Indian or developing country perspective is absent, gone without any discussion. There's nothing about it in here. And when pressed, the OECD says, well, this is the consensus. Well, I know what the consensus is, and so do all of you. The consensus is, what do we think the US will agree with? Well, I have news for you. The US is going to do what they did in the Harmful Tax Practices Project. They're going to shape this agenda. They're going to create the narrative that works for them. And then when the push comes to shove and it's time to put your name on the paper, they're not going to put their name on the paper. But I'll leave that political economy discussion aside for the moment and note that this Secretariat's proposal is the one that's on the table. This is the one we're having a conversation about. We're not having a conversation about other proposals. And so if this one fails, this is a big gamble. If this one fails, there is no plan B. Plan B is all those unilateral digital services taxes. And we can see the proliferation is a warning sign to us as to where this is going. You can imagine that there's some unrest with this, lack of ease with this at the OECD. So far, so good. That's the background. Let's get into the details. All right, this is the Secretariat's approach. The example from the unified approach, all right? This is the idea. Looking at the text on the right, the first bullet point says that jurisdiction 1 and jurisdiction 2 share group X income using the arm's length rules. So if you look at a picture on the left, what I've done here is created the 3 jurisdictions with the 3 colors, green, purple, and orange. And you can see on the far left, it says group X. So group X is any player, any person, legal or non, or PE or digital PE or anything that's part of this group that's creating profit. Okay, now normally we would say group X is only in jurisdiction 1 and jurisdiction 2 because that's where we have entities and permanent establishments. And we would not have anything going on in jurisdiction 3. So that's why I say that jurisdiction 1 and 2 share the income, and they share it using arm's length, right? The idea is that QCO, that's the OECD's letter for jurisdiction 2 subsidiary, QCO is going to make claims about what its income is based on its functions. And then by default, the rest of the profit obviously belongs to PCO, which is parent co in jurisdiction 1, the headquarters jurisdiction. Okay, so that's why I say jurisdiction 1 and jurisdiction 2 share the tax base, share the profit of group X, And the way they allocate it between those two jurisdictions is arm's length rule, right? And so again, looking at the text on the right, jurisdiction 2's earnings are the returns on sales, marketing, and distribution activities. And jurisdiction 1 earnings is everything else, including all the profits we associate with high value IP and intangibles. So then what about J3, jurisdiction 3? There's no allocation of Group X's earnings under the arm's length rules. Look at jurisdiction 3. What is it? It's just sales to jurisdiction 3 users in this example. Could be also advertising to companies in jurisdiction 3, for example, to buyers in jurisdiction 3. Okay, so but there's no PE, there's no traditional nexus, there's no person to tax. So therefore, jurisdiction 3 right now doesn't get any of Group X's profit. And jurisdiction 2 just gets the profit associated with the subsidiary, the marketing and distribution return. So jurisdiction 1, where the IP is, where all the residual profit is going, it's all in jurisdiction 1 in this example. All right, so the question, the bottom of this slide on the right, the question the OECD seeks to answer, if jurisdiction 2 and jurisdiction 3 don't get enough tax base, according to them, can all the jurisdictions agree to redistribute? And if so, whose share is going to get redistributed to whom? So I'm going to make a bunch of really simplifying assumptions here as I go forward, because the fact is, jurisdiction 2 could have some IP. Jurisdiction 2 could have all kinds of things other than marketing and distribution. And so each time you're thinking about this, you have to think about, well, what does this multinational's financial capital structure look like? Where are their assets? Where is their value created? And what you see is jurisdiction 2 has a little bit of the profit of Group X, and they want more. They want more because they think they're a market country as well. And I think this is akin to, sometimes you hear people talk about location savings. That's, I think, jurisdiction 2's position. We provide the market and the users, that's valuable. We want more than just our return to marketing and distribution. Our national endowment is producing some of this, more of this value than you think. And jurisdiction 3 is tagging along saying, well, what about our national endowment? We also are providing users, we also are providing a market. And the company here, Group X, just simply doesn't have a PE or a traditional PE or a subsidiary here. And so we get nothing. We get nothing for our users in our market. We don't like that. We want something. So you can imagine that if jurisdiction 1 is the one that's going to be asked to provide some of that tax base. So the OECD says they don't think that Pillar 1 or the digital economy project is a win-lose scenario or a zero-sum game. They don't want us to talk about who are going to be the winners and who are going to be the losers. But it's clear if you're moving tax base around, you know, you have to take it from somewhere in order to put it somewhere else, unless what you're going to do is double tax. And that's obviously the thing the OECD is trying to avoid most of all. So who are the winners? Who are the losers? Well, the next slide is based on it just came from my brain. It doesn't have, there's no source. So you can help me with this one. I just took all the inclusive framework members and I said, all right, well, what do we think they primarily are? You know, who are these jurisdiction 1 headquarters that are probably going to lose some tax base to some other countries? And who are these jurisdiction 2s that maybe have some traditional nexus and some traditional entities and some marketing and sales returns, but they want more? And then who are these third jurisdictions where they don't have a PE and there's no subsidiary? You know, your guess is probably as good as mine and maybe better than mine. And this is just a stab that I took at it. So if you look at this and you say, well, that's clearly wrong, I wish you would drop me a note and tell me, you got to change the color of X country to purple or orange or green, because they're really this other kind of jurisdiction. What you can't see in this map, because the map of the world does not reflect the financial size of the world, what you don't see in this map is a whole bunch of little dots that are in green, which are headquarters jurisdictions, I think. And the reason I think that is because in the OECD's impact analysis, they talk about what's the term they use? It's for these intermediary jurisdictions whose GDP is 150%, or FDI is 100%, investment is 150% of GDP or something like that. This is their conduit jurisdictions, right? these are the headquarters jurisdictions that they say in the impact assessment are going to see a reduction in their tax base. So you can't see those on the map because they're little places physically, but they're giants when it comes to finance. All right, so just thinking then that there's these countries that are jostling for position. And if I look at this map and I see two countries that I think are kind of a big deal in terms of probably being J1s, jurisdiction ones, headquarters countries, they are not going to want to go along with the OECD if the outcome of the OECD is to push too much income into these other countries. They might go along for the sake of harmony and certainty and stability. We know those are the things that the OECD likes. They might go along for the sake of those things if the redistribution is minor. I've heard the word sprinkling used to explain how much of a distribution would be acceptable. So a minor sprinkling would be okay. But what we will not go along with is anything that's going to really upend the apple cart. And you know what looks like it's going to upend the apple cart? Well, it's the digital, unilateral digital services taxes. So we can see there's this pressure. These green countries do not want to see their tax base, what they consider their national endowment, moved around to other countries. They don't want to see that. And they certainly don't want to see it being done on a unilateral basis, because then you have to hit every one of those countries with some sort of trade violation claim, and then you have to fight with them. Or you have to start a trade war, a retaliatory trade war. So that's a problem. So the OECD is caught in a vice. You have countries that want things redistributed to them, and you have the OECD trying to navigate with the US, which is unreasonable. They're unreasonable about this. Sorry, they just are. They will not accept what everybody else in the world, or 100 or so countries, think is reasonable. They will not go along. So you're in a vice. You have to find a way. I think it's a great project, and I wish them all the best in it, but I'm not optimistic. Okay, I can't see the chat. I can just see stuff. So I just want to pause there to see if anybody needs to jump in before I jump into the technical details of Pillar 1. How are we doing, May?
Yeah, so no questions so far. So if you guys have any questions here, put them in. You can either raise your hand or put the question in the meeting chat box, and I can read it out for you guys. My question for Allison to begin with, actually, just quickly, is are there any historical incidences of winners and losers, and as close as possible in this type of thing that the OECD could glean from? And then two, you mentioned the map has these tiny dots. I can probably figure out which dots that are not shown on the map, but could you mention a few of these top giants that are there?
Yeah, so the giant dots are, well, you're sitting in one of them, obviously, the Cayman Islands. Lucky you. The giant dots are, these so-called offshore financial centers, some of them. They're places where you can put that IP that's going to pull all that residual profit from Group X. That's where they are. So any place where you can put it. So you can imagine that's Ireland. I think the Netherlands is probably green on my map. Most of the islands that we associate with, the pejorative term of tax havens. I don't like to use that term because I think that term refers to every country in the world to some extent in some different ways, most countries, in particular the US. So, it's a tough language, but that's the idea. Any place where you can put a legal asset which will pull the profit, that's a jurisdiction 1, I think, in the lexicon, in the ideal. Okay, so we'll move on then to the unified approach. Okay, so this is now getting into the weeds a little bit. I'm sure you've seen it, amount A, amount B, and amount C. It's really hard to use these abstract letters and have them mean anything, but this is what we have to do. This is what we have to work with. So amount A, well, what is amount A? We have to do amount A first for a reason, but I'm going to explain later that I think this is actually it's a mistake. Like amount A should not be first. Amount B should be first. And I'll explain why. But amount A is this formula-based return of a deemed residual, AKA non-routine profit to market jurisdiction. All right, so this is effectively, if you like, digital PE, right? This is the amount that's going to be attributed to a digital PE. So the thing is, because it's formula based, by process of elimination, whatever that formula creates, it caps the profits everywhere else in the formula, everywhere else in the group. So if amount A says, this percentage is amount A, then there's only so much percentage left to be amounts B and C. And that's a problem because, as you'll see in the middle, amount B is supposed to be arm's length. Well, if it's going to be arm's length, an arm's length return can't be formulaic by design. It has to be studied. It's a matter of facts and circumstances. We have hundreds and hundreds of pages of guidance, hundreds and hundreds of pages of cases, lots of insider information, databases, huge, massive databases of information. Arm's length return is not going to be possible if you've already carved away some amount A. So over here on amount A, I have that little call out below saying amount A is effectively capping routine profits. Amount A is non-routine profits, but it effectively caps routine profits because it's just taking away some amount and saying that part just isn't going to be distributed according to the traditional rules. So if that threshold for amount A is too high, if amount A takes away too much and the arm's length doesn't have enough left over, then you have an allocation problem. You're going to have an overlap of amounts distributed per formula, amount A, and amounts distributed by arm's length, amounts B and C. This explains, I think, why when we come to amount B, you see some discussion. Okay, yes, mostly this is the normal return to marketing and sales activities, but we're going to consider a fixed return for baseline marketing and attribution functions. This is where the KPMG study comes in because that's what the KPMG study is looking for. It's saying, okay, well, what would that baseline marketing and distribution function amount look like? What might that percentage be? Could we find a fixed return percentage? I'll come back to that in a minute. And then amount C is supposed to be an arm's length return for value adding functions in traditional PE and subsidiary situations, right? So amount C is saying, okay, you do more than sales and marketing in your jurisdiction. That means you already are entitled to a little bit more under arm's length. So we'll let you do your arm's length. But remember that the OECD's key point is stability. So amount C comes with a big condition attached. And the big condition is, well, we'll let you take these additional returns, but you've got to agree to binding mandatory arbitration in case of disputes. In other words, we're going to let you try to take a little tiny bit more, but if you do, and if the other countries don't agree, you don't get to draw that out in a long and complicated competent authority process. You've got to agree to mandatory binding arbitration. I'll pause to see if there's any problems or questions. I see something flashing in the chat.
Leopold, if you want to ask your question.
Yes, I do want to ask a question, Alison. Thank you. I was actually following your example, and don't you think that amount B, actually, I mean, I share most of your criticism, but when it comes to amount B, don't you think that it also solves a problem that is present in most of developing countries, which is that most of the litigation, transfer pricing litigation, has to be actually with marketing and distribution functions. They don't know how to do that. So
that's
now,
a good point.
If we have a formula there, actually we avoid a lot of that litigation. So it can also be, let's say, from a positive perspective. Don't you think that?
Yeah, sure. I'll give you that normative assessment. Absolutely, right? Like that is, it's a net good because it makes life easier where currently transfer pricing is effectively impossible. And I agree with you, it's effectively impossible in a lot of places. So absolutely good point, Leo. Thank you for that. I think the only thing I will say about that is I don't disagree with that, but that's not arm's length. It's formula. And if you're going to do formula, why don't you go all the way and do formulary apportionment? I mean, come on, let's, right? So yeah, So good point. It's a good point, well taken. Okay, so having shown you amount ABC, I'll just do it sort of the same thing, just a little slightly different way, just to show the visual how this all works. Okay, so you see that the total profits is above the purple. So total profits is split in two. We have non-routine profits and routine profits. So I'm going to look at non-routine profits first because amount A has to come first because that's the formula, definitely using a formulaic approach. So by process of elimination, you have to do non-routine profits first. And that's what the OECD does in its unified approach. So just focusing on, so we've split the line. So the first task is we have to figure out the difference between routine and non-routine. And I'm doing some work on a global excess profits tax where I'm likening that same idea to where you look at normal and excess profits. You see it in normal and abnormal profits. You see it in windfall profits, right? Wherever you have to decide, well, what is the mark? Is this thing that we're familiar with producing, you know, the routine functions, and what is this extra that you're getting, and how do we know when we're there? So once we're there, we have this line between non-routine and routine. Now, if we look on the left side, non-routine profits, there is this, there's two parts of this. We're going to split the non-routine profits into two parts. The first part is this new amount, right? This is the digital PE amount A. This is the part we're going to distribute by formula. But then everything else, all other non-routine profits are going to be split the way they always have been by arm's length transfer pricing. So that's a little, you know, confusing, but you just have to remember that you have to do a percentage for this new amount, this new digital PE amount for amount A, and then everything else, you say, well, what am I supposed to do with this stuff? Oh, well, I still distribute it the way that I did before between jurisdiction 1 and 2, which means that this is how you isolate what is actually going to go to jurisdiction 3. Jurisdiction 3 can get a little bit of that new amount associated with the digital PE. You're not going to get anything else of those non-routine profits. So it really matters what this little tiny slice of the new amount is. This new amount slice is, I'm going to talk about in the next slide. This is where we're going to have the battle, because if it's too small, you're going to see unilateral digital services taxes because countries are entitled to their endowment. And if it's too big, then the US is going to not agree, and therefore there will be no consensus. They won't agree anyway, and there won't be a consensus anyway, but it will be even more obvious that the US won't agree if it's too big. So that's the non-routine profit side. Now look at the routine profit side on the right with the red. So this is in 3 parts. We have the return to limited risk sales, marketing, and distribution. That's amount B. We think that they're going to distribute this by arm's length transfer pricing, or we're going to get that fixed margin to be determined. So the fixed margin, it matters because amount B is what jurisdiction 2 gets right now. And then amount C is this additional, this return to value added sales, marketing, and distribution. This is amount C, and this, I guess, is going to be done by arm's length transfer pricing. That is why the KPMG study focuses on what is going to be that value added return to sales, marketing, and distribution. And we'll see in a minute what they come up with. And then the third piece of routine profits is everything else, and everything else without any other rule to tell you differently is going to be distributed by arm's length transfer pricing. If you look at this structure and think that makes sense, that's going to be workable, then I want to talk to you because I don't understand. To me, it looks like a mess. So one more slightly deep dive. Then I'm going to stop because there's an example, but I'm not going to go through it because that's too much. So this is the amount A formula. And these are the OECD's letters. So Z, the worldwide profit margin, minus this deemed routine profit margin equals the deemed non-routine profit margin, Y. And then Y, this deemed non-routine profit margin, minus the arm's length share, V, equals the market jurisdiction share, W. So the W is that small box, the first box above in the non-routine profits. That's the part that's going to get redistributed. And then how are we going to redistribute? Probably by some formula. And I speculate that it's local sales or users over worldwide sales or users, similar to the DSTs that we see. I go through an example, and you can, these slides are on my website and I have notes in there, and it's a little bit too much information. But once you understand these sections, these parts, you'll see I've just slotted them in, and I've just come up with a example with 30, add as many zeros as you need, $30 of worldwide profit on 125 in worldwide sales, but we won't go into detail here. And then I go through amount A, step 2, step 3. I'm going to assume sales in different jurisdictions and apply my sales-based formula, okay? So I'm going to skip this because it's heavy detail and it would take us too long. But here's the result. This is the big picture. So using the OECD's numbers and the KPMG's estimates, what you see is that there definitely are going to be winners and losers, right? Like there's no question about this. And I think this is a decent depiction based on, all the assumptions that I've made, which is, they're ridiculous, obviously. They're just made up. But this is the idea that green jurisdictions, jurisdiction 1s, are right now being assigned most of the group's profit. And jurisdictions 2, where sales and marketing take place, are being assigned some of the profit. And jurisdictions 3s are buying the products, goods and services, and they're getting none of the profit. That doesn't mean they can't tax. They can tax goods and services with a VAT, but it means they're not getting a tax on the profit of the multinational. And so the result of Pillar 1, the result of the digitalization project, is to take a little bit out of jurisdiction 1s and give them to jurisdictions 2 and 3. But it's going to be modest. I think in my slide, I use big numbers to try to show the result. But in fact, when you plug in the numbers that the OECD and KPMG study propose, the sliver of orange is minuscule. It's almost non-existent. And the change for J2 in purple is also pretty modest. That is, right now, with the assumptions that we are working with now, there's not too much redistribution going on. Now I see Leo's hand up, so I'm going to take that because this is the end of the technical part, and the next slide is going to be the 301 analysis, the U.S. trade rep response. So Leo, go ahead.
Alison, that's fascinating actually that you got these numbers, and I was thinking actually looking at your numbers, and also in some previous slides you showed this example with the 3 jurisdictions, and I was thinking, even if you have this amount A in jurisdiction 3, what's going to happen with the enforceability? Because we have basically a non-resident, a non-physical presence. So the only way that, from a normative perspective, that I think that we can catch that as a jurisdiction 3 is a withholding tax.
You got it. Yeah.
What is the problematic with that? Probably jurisdiction 3 will see that the taxpayer of the withholding tax is Q company and not P company, right?
That's
it's not
right.
the parent, is a subsidiary, which will create, of course, also a problematic issue, because it's not only that jurisdiction 3 will get a very little amount in numbers. Most probably it won't be possible to really enforce it. What do you think about that?
Yeah, so same exact analysis for a unilateral digital service tax. Exact same problem. If you do not have a subsidiary in your jurisdiction, that's why you don't have nexus. That's why you don't have traditional that's why, because you have nobody to grab and no assets to grab. That's why there's no nexus to start with, right? That's the world we built. It makes sense. It actually makes a lot of intuitive sense. If you're going to start all over and build a tax system from scratch, you start with, well, who are we going to tax? Okay, so we can tax people that live in our jurisdiction, and also we have the power to grab stuff if we have a state. So that means we can also tax in rem. We can tax assets, items. So that means we can also grab things in payment of tax, which allows us to force withholding on people that own assets. That's the basis of the international tax system we have today. If you don't have an asset and you don't have a person, then you don't have a tax. You don't have a tax jurisdiction, or at least you don't have an enforceable tax jurisdiction. Now, it's interesting, though, that Australia adopts a diverted profits tax, and it's very successful. it's interesting that if you look at the text of the French digital services tax, what you see there is, okay, easy, low-hanging fruit first. If you have a subsidiary in France, that's your designated withholder on this other tax that's not their profit. It's, you know, it's the parent's profit. That's your guy, and that one is the one you're going to go to say you've got to withhold and give it over. And if you need to reorganize your profits between you and P, then to make up for the tax you've withheld, then yes, your business, go ahead and do it. But where there's no Q company, look at the French digital services tax as a guide. You know, they're saying, well, we're just going to make the law, and you have to comply. You know. We'll think about what we'll do to punish you if we catch you when you don't. Now, I'll just add one other piece to that. In Quebec has its own digital service tax of a kind. It doesn't really. It's just a VAT. It's just an extension of its VAT requirement on non-resident sellers, which, of course, in EU you're very familiar with. But the Quebec has no way to force you to do that. They don't. You're not here. You don't have a presence, you don't have a PE, and you don't have any assets, and you don't have a subsidiary. So they just made a contract. They made a contract with Airbnb, I think Netflix also. And they said, okay, listen, we want you to withhold this tax, which is a value-added tax on the users here. And the companies just agree. Now, of course they agree, because that's not on their profits. It's on their the consumers, and it's a withholding tax of a consumer tax. So the company just passed that tax on. But it's the exact same idea, I think. The enforcement is messy. It's messy.
It's basically that when you read the report from the OECD, from Secretariat, what's my impression is that they are trying to direct the attention, like the potential taxpayer will be the parent company. But in reality, who is actually selling in this market when there is no physical presence is not the parent directly, it's a subsidiary. And this is a problematic that I see. And I can take this very simple example of Spain. In Spain, by law, which is not tax law, they will basically say, no, the taxpayer is Q and not P. And there is no discussion about this. And that of course is a pure normative argument, but it will create troubles, because this is a domestic decision. It's not that tax treaties will solve this, right?
Yeah, I agree. Do you think that, well, so you are of the mind that the EU or the US or both will strike down unilateral digital services taxes as discriminatory? I totally disagree with you. I'm going on record right now on that. No discrimination. You're absolutely wrong. But you're of the mind that this is not going to work because of a discrimination problem. So you add on top of the enforcement problem, you add a litigation risk or for states at the state level, where they're going to not only if
basically because of the use of thresholds. I would say that I still believe it, at least from an EU law perspective, that there will be good grounds for basically going against digital services taxes, or even if this proposal is basically also using thresholds, most probably will face similar problems. And it has to be a very simple reason. Under EU law, it's not only direct discrimination that is prohibited, it's also indirect or de facto discrimination, right? So if I have these high revenue thresholds, so these high turnovers, what I'm doing, let's say France is doing when it has its digital services tax, is ensuring that almost no French companies pay that tax.
Leo, come on. The only reason that's the case is because the first movers are American companies, and they have de facto monopolies. There might be a competitor, but they're too small. That's just now. I mean, if a competitor creeps up and becomes bigger than Google, but it's really hard to imagine that right now in Amazon. They're just their first movers. But you and I can have a debate about that, because you see that as de facto discrimination, and I see that as de facto monopoly that hasn't been stopped by antitrust laws and is maybe not stoppable, especially now that those firms are so integral to services provision, in the pandemic, Amazon.
There is a very interesting argument, and I take it, and I would not disagree with that there is a sort of monopoly of these kind of services, but doesn't change the fact that from a pure legal perspective, you are still creating a differentiation using a category that is basically being equivalent to say, I'm going to use nationality to simply create a tax that won't affect my nationals.
But it does. It does affect the French. There are some French companies in the mix.
One.
Okay, one right now, but there could be another one tomorrow. We've got Canadians companies in the jurisdiction. I put Canada as the jurisdiction too, but there's some Canadian companies that are J1s. Come on.
I do agree that actually this won't be the same in all member states, but in the case of France, it's very interesting because you have out of 30 potential taxpayers, only one will pay the tax. And then on the top of that, because I'm not saying that's enough, we all know that under EU law you can still have a discriminatory tax, but if you justify it properly, it will pass the let's say the threshold of the court, right? So you can justify it to the extent also that is proportional.
Okay, well, I need a European lawyer to help me because I disagree with you fully, but I disagree with you on the merits, and you give me law. So I need a volunteer. Somebody volunteer to.
Okay. So we're just going to move on to a couple more questions, Leopold. We're going to have Henry give a question first, and then Alice right after that.
Go ahead. Hi, Henry.
Hi, Allison. How are you?
I'm great.
Nice to hear you. Okay, so have you given any thought to whether the United States, with respect to the digital services tax, gets boxed in a little bit by the Supreme Court's recent decision in Wayfair?
Wayfair, yeah.
And whether that gives the necessary nexus that for France to tax Google then?
Yeah.
Okay.
Yeah, good. Excellent. Yeah, that's the argument. That's right, Henry. Thank you. That's the argument. So Wayfair, which is a state local issue in the US and it's getting a lot of discussion, clearly is not limited to state and local issues. It's a jurisdiction granting case that I think flies in the face of the USTR's position on unilateral DSTs. So well done, Henry. Henry's going to help me make this argument that there's certainly no discrimination and there's certainly nothing unreasonable about unilateral digital services taxes. They're just really inconvenient if you're trying to build global consensus. I think Alice was next.
Yeah, I just also would like to offer my support. Wouldn't say there is no risk of discrimination at all, but I think I could make good arguments to say that the French tax, for example, is not discriminatory under EU law, nor it's discriminatory under international trade law. But yeah, I'm working on the article, so when it's finished, I send that to you.
I look forward to reading it. So, okay, well then maybe you have something to say about the place that I'm going next, which is this USTR stuff, right? So then, Alice, you've been studying this for sure. You know that the USTR initiated a Section 301 investigation into France last year and issued a report in November or December, I think, which is must read. I mean, it's just fascinating. It's a fun read. It's a maddening read, but it's an interesting, view, a very classic American view, which is, well, you can't tax our companies. We reserve the right to tax our companies. And by the way, we are not going to tax our companies. So hands off. That's our national endowment you're messing with, and we will retaliate. Well, the French DST investigation, the 301 investigation into the French DST was, I think, for sure, a shot across the bow. Do not adopt DSTs. We will be investigating you. And France and the US, had a little tweet exchange. Some of you might remember it, where Donald Trump said, you can't tax our companies, and anyway, American wine is better than French wine. And the compromise was, okay, everybody calm down. France will put a hold on their DST until the end of 2020, and the OECD will produce consensus. So the US message is just wait for the US to produce consensus. But FYI, in case you're not aware of it, we're not going to agree with anything the OECD proposes. Whatever they say, we'll say that's nice, that's a nice safe harbor, or that's a nice idea for whatever, but we're not going to adopt that as a binding law on ourselves. We don't do that. We're the United States. So the warning shot against France doesn't seem to have worked. So I posted on Twitter last night a timeline of digital services taxes, which I put together with the help of a student, and even though we tried hard, we missed a few, so I've added that, and I'll update that chart. But I think right now my count is 18 jurisdictions that either have or are proposed or are thinking about a digital services tax. That's the map I showed you at the beginning. That 18 jurisdictions, maybe 19 now, but 18, I think, either have it or are proposing it or are seriously considering it. And 16 of those since the U.S. announced its first investigation into France. So the deterrent of 301 didn't work. And it is, make no mistake about it, a deterrent. This is a unilateral process whereby the U.S. stomps its feet and says, hey, you're discriminating us, and you're doing something bad, and we might do something about it if we decide upon our investigation that you've done something bad. And in November, they decided that France had done something bad, but they haven't done anything about it yet. And now we see from a couple of days ago, they initiated a Section 301 investigation into 10 more DSTs, and they'll do their investigation and they'll stomp around and say, this is outrageous, this is discrimination. And then they will agree with themselves. Oh yes, we have investigated, we have agreed with ourselves, it is discriminatory. And then they have to decide what to do. And that becomes a political process. So now you have to decide, are they going to go to the WTO agreements, GATS, for example? Are they going to use GATS and say, what's happening with these DSTs is an effective tariff, and we get to retaliate now under GATS? They can't do that alone. They are going to have to initiate a way to impose those retaliatory tariffs without themselves falling afoul of those trade agreements. So Alice, this is your wheelhouse. You are looking at this, you have more to say about this than I do, and I will let you chime in if you've got more to say.
Very curious to know the arguments why you and Alice are so convinced that from an EU law perspective, digital services taxes are not discriminatory.
I'm not from an EU law perspective. Alice is good.
I have 5 minutes, so I would love to hear the arguments of that.
Yeah. Alice, why don't you?
Yeah, I'm happy to step in. So it really depends how you look at those taxes, right? So what are they trying to do? What's the rationale? And the rationale is that those companies are not paying taxes in France, right? So when you say that they are discriminatory vis-a-vis US companies in comparisons to French companies, you're starting from the assumptions that those French companies are not taxed in France, but they are, because they are subject to the normal corporate income tax. And so I see your point saying that it's discriminatory because it's sort of a new tax.
It's not my argument, actually. My argument is basically that, first of all, it's not a discrimination against American companies. It's a discrimination against the subsidiaries of these companies that they are in other member states, right? So that's the reason why the argument comes. Otherwise, we wouldn't care. I mean, who cares if we are discriminating against American companies from an EU law perspective? But we know that it's not like that. We are discriminating against Google in Ireland, most probably, or any other technological companies listed in the impact assessment from the French DST. Now, there is enough evidence from the court in the past saying that when there is such a disproportionate impact, which is not enough to say that there is discrimination, but there is indeed enough, let's say, an argument strong enough that we can use, and then build upon that. So my argument, the argument that I raised with Ruth many times, is basically that on the top of that, the court could also think about another element that is actually normally disregarded, which is the intention to discriminate. Mm-hmm. I know that then I'm crossing a field that I will have a lot of resistance, but think about it. The court will have not only available the possibility of saying 29 out of 30 companies are being affected by this tax. Okay, still it's not enough to say that it's discriminatory, but I have all the declarations from the officials in France. I have the law. I have, if you see the Austrian tax.
All right, guys, sorry, I've got to call this time. So we try to end it on the hour. So thank you very much for the discussion. Alice, I'm going to give you 30 seconds. We have to make 30 seconds to give it any commentary that you want, and then Alison another 30 seconds.
Oh, yeah, no, I totally see your point. And as I said, I'm not saying that it's fully sure that it's not discriminatory or fully sure that it's not discriminatory, but I think I could bring up arguments to say that it's non-discriminatory, certainly under international trade law. And I totally see your point.
In a few weeks on that.
Good, excellent. I look forward to that discussion, Alice. I look forward to that. Awesome. All right, so I'll show you in the slides. You can see the references, and you can send me email and complain to me about anything I say that you disagree with, or correct my record. Leo, you and I will have a chance to hash this out some more. I think on June 18th, I'm going to present, I'll talk about I think I'm going to talk about my proposal for a global excess profits tax, which certainly doesn't discriminate against anyone. But we'll talk about that then. Let me just say thank you so much to May and everybody at the Cambridge Tax Discussion Group for hosting me today. I do have Teams fatigue, but it was really fun discussion talking with all of you, and I look forward to continuing the discussion. Thanks, May.
Right. Fantastic. Thank you very much, Alison, and thank you for everyone here for attending. We're going to have weekly meetings from here on online for the whole term. Next week, we're going to be meeting at 5 p.m. British Standard or British Summer Time, and we've got Alexis Brassi talking about the concept of fairness means in an international tax context. If you'd like to join our mailing list, which is separate from our website, send Guy or myself an email and we'll add you to the mailing list, which will send you the link directly. But otherwise, thank you everyone for joining us, and have a good day.